Have you ever stopped to think about how just a few extra percentage points of investment returns might change the outcome of your goals? It might surprise you to learn that the difference between a few percentage points can literally mean millions of dollars. Today, we're going to look at a portfolio that was created on this idea that every extra percentage point is worth fighting for.
Look, in the end, 90% of your return is based on your equity to fixed income exposure. And this idea of factor investing, small cap value investing, is simply the icing on the cake. And sometimes it's the flavor of the icing on the cake. And sometimes it's the sprinkles on top of the icing. It is not the cake. So in trying to keep things very simple for investing, for investors, you have to decide how much they would have in equity, how much you're going to have in fixed income, how much you're going to keep aside in cash, and then maybe slice the equity between international and U.S. And after that, it's really the icing on the cake. If you want a little bit of small cap value, that's fine. We'll put as a small cap value in there. If you want some real estate in there to boost up your real estate a little bit, because real estate is a big portion of the economy, that's fine. We can put a little portion of real estate in there as well. But don't focus on it. Focus on the cake.
Today, we're going to analyze Paul Merriman's ultimate buy and hold portfolio strategy. If you watched our 2020 portfolio challenge results video, then you already know that this strategy didn't do so well in 2020. But don't let that deter you from considering this portfolio. Remember that in the life of an investment strategy, any single year is really entirely meaningless. This portfolio is going to be featured in my 2021 portfolio challenge, so please subscribe if you want to keep up to date with how the portfolios in Season 2 are doing. Everyone knows that the S&P 500 index will return about 8 to 9% annually on average. So if your goals can be met with that return, then by all means, please go watch my Simple Path to Wealth video and invest in that portfolio instead. This portfolio is all about factors or styles. Up to this point, in all the portfolios that we've analyzed, the stocks have been represented as a single asset class. When we say stocks, we're talking about the S&P 500 index, and we assume that anyone buying stocks is going to get the same return as the index. Of course, you don't have to use the S&P 500 as your stock's asset class. You can use stock factors like value stocks, or growth stocks, or international stocks, or small cap stocks, or emerging markets, or any number of other factors. I think you'll understand the idea of factors better when we walk through Paul Merriman's process of how he creates his portfolios. To start off, I think we should probably look at pension funds and general endowments. See, pension funds pretty much all use a baseline 60-40 portfolio. That's to say that they use 60% U.S. stocks and 40% aggregate U.S. bond index. Historically, that gives us about a 9% annual return with roughly a 9 or 10% standard deviation. This is more or less our starting point. We need to construct a portfolio that exceeds an annualized 9% return and doesn't exceed a 9% standard deviation. That's our criteria to determine whether we've created a valid portfolio or not. Step 1 in Merriman's portfolio creation process is to get the bonds right. Merriman doesn't generally like long-term U.S. Treasuries because their risk increases over time disproportionately to the returns that you get. Merriman recommends that we swap the 20% bond index with intermediate term treasuries instead. Step 2 is to add some real estate. If we follow Merriman's guidance, we're going to split our allocation to 48% stocks, 40% intermediate term treasuries, and 12% real estate investment trusts or REITs. We can see that this small change has increased our return modestly by about $3,000 or so. We also have lowered our risk, and our worst year is much less bad than the 60-40. Step 3 is to add some small cap stocks. So here we're going to change the allocation again. Now we're looking at 36% stocks, 40% treasuries, 12% REITs, and 12% microcaps. We can see that this change has increased our alpha by about $10,000. Our annual rate of return is now over 9%, and our standard deviation is lower than 9%. So far, so good. Next up, we want to add some value stocks. With this mod, the portfolio is now 12% US stocks, 40% treasuries, 12% REITs, 12% microcaps, 12% small cap value, and 12% large cap value. With this change, we've increased our return over the 60/40 portfolio by about $6,000. But remember, this is $4,000 less than we got from adding just small caps. Standard deviation is still better than the 60/40, but it's also worse than the small caps version. Well, let's keep going. Step 6 is to add some international stocks. So we're going to tweak the allocation again. For the new allocation, we're going to be adding 6% emerging markets, 6% international small cap value, 6% international large cap value, 6% international large caps, and 6% total international stock market. Well, looking at these results, it's clear to me that we are moving backwards here. By adding these international asset classes, we've somehow managed to return $18,000 less than the classic 60/40 pension fund. The last step in the process is to flatten out the portfolio. We want to allocate our capital evenly across 10 different asset classes. For this last backtest, I'm going to use the all stocks version of this portfolio, which is outlined on Merriman's website, but it's not really a fair fight to compare a 100% stocks portfolio to a portfolio with 40% bonds. But hey, if an all stocks portfolio can't beat one with 40% bonds, then it's not really a great portfolio, is it? And again, I'm frankly shocked by these results. This is not at all what I expected to find. It's been probably 10 or more years since I last investigated this portfolio, and at that time it was a big winner. But that was then. And as we currently stand here in the first quarter of 2021, we can clearly see that this portfolio is a loser. I mean, look at these results. It clearly got its ass handed to it by the most basic portfolio in the history of finance, the 60/40 pension fund. And look at that standard deviation. That's just crazy. Wow. Well, if it isn't obvious by now, when I sat down to write this script and analyze this portfolio, this is not the conclusion that I was expecting we would come to today. But here are my thoughts on the Merriman Ultimate Buy and Hold strategy in 2021. And it really hurts me to say this because I've read all of Merriman's books, and I really admire his skill and his tenacity. He's a great ambassador for the cause of financial independence and sound investing. But for his portfolio, sadly, I'm going to have to put a sell on that.